What normally we say is very clearly is that for the first 4 months, there is zero margin, and therefore we allotted a bit of equity. Our upside, our margin is actually converted into equity. When you think about it, it actually means that our cash compensation is worth less because now we're trading it into equity, right? And equity, obviously, I mean, the dollar today is definitely always worth more than a dollar tomorrow. So we take the risk already, right, as such. For the next 12 months, the amount of money that we ask to actually support the day-to-day is negligible compared, right? If you put it in the tunes of even some of the cheaper consultancies, probably 1/10 of what they ask for, right? For that. And we take on then the responsibility of making sure that the venture arrives to a Series A, to an investable steps.
So welcome to our new episode of this podcast about Agile. I'm Hugo Messer, the host today. I'm going to interview somebody special who has come to Indonesia and gained a lot of experience on how to do innovation. So the topic for today is mostly innovation. So I wanted to start by relating innovation with Agile. In my opinion, if we talk about Agile, we talk about transformation. So we're trying to change people. We're trying to change a large group of people in an enterprise to work and think in a different way. So Agile transformation has three pillars usually. It's about Agile, which is about changing the way we work. The second is about digital. So we want to create digital products, especially since COVID forced a lot of companies to become more digital. So it's about creating digital solutions, using digital tools in order to service clients in a different way. And the third pillar is innovation. Innovation means creating new products, new services, or doing things in a completely different way. And what I see in the landscape today is a lot of enterprises have a pattern of creating innovation. And most companies, when they start thinking about innovation, they start, for example, accelerators. So looking around in my LinkedIn, I see every day some big venture, some big enterprise talking about or announcing some new accelerator in which they call upon startups or founders or people with great ideas to join their competition. And then when they're good enough, they will earn a decent amount of money. I've tried that myself as an entrepreneur, and I believe this is not always the best way for entrepreneurs nor for the corporates. So what I want to discuss about today is a new way to start this innovation. Instead of doing an accelerator, starting something new. Instead of hiring a consultancy that preaches you how to do innovation or how to start innovation, you can do it in a different way. And that different way is venture building. So in this episode, I've got Ziv Ragowsky, who is an expert in this topic. So he's done venture building himself. He's done it for corporates. And that's what we're going to discuss about today. So Ziv, please introduce yourself.
Nice to be here, Hugo. Thank you very much. I wouldn't describe myself yet as an expert, but thank you for the vote of confidence. So I've been in Indonesia for the last 10 years. I actually came here as a consultant. And since 2014, left to first run my own startups, then do some corporate innovations, both in Myanmar and in Indonesia. And about 8 months ago, together with a few partners, we've put together Wright Partners. Wright Partners is a venture builder, as you mentioned. It does aim to be a bit different than a consultancy venture builder, which is what we see in the market right now. We've been, so over the last 8 months, we have created an organization that has worked together with around 6 mandates with 4 different corporate partners. We call them corporate partners and not clients. Together with them.
Why is that?
So very good question. Clients assumes that there's a relationship that is not a partnership. We are a vendor. We're providing a service for someone. In the venture building, the way we think about venture building is to partner together with our corporate partners to build something new. And so that means that we are partnering with them. Therefore, they cannot be a client. So in the last 8 months, we have now worked on 5 different ventures that are equity investable ventures. We focus on investable corporate ventures, which are ventures that ultimately could be invested by an outside party. Yeah. Right, and we'll talk about that a little bit later. So out of the 5, 4 have already passed investment committee, which is good. And then 1 more will actually go through investment committee next week. And then we've done a bit of other work as that. So quite exciting and very excited to be here.
Okay, cool. Thanks for the intro. So maybe for the audience that doesn't know yet about venture building, try to explain the term venture, because for me it calls upon the term of startup, and I think venture is somewhat similar but also different. So tell us a bit more about what a venture is and how venture building works.
Right. So I think based on your earlier structure, you suggested that there is essentially three pillars, right? The initial transformation, changing the way people think, digital, and obviously then ultimately innovation. Within innovation, you mentioned that there's new services or new capabilities that can be built. What we focus on in venture building is a new venture, which could either be a new business unit, but we actually shy away from focusing on business units,
Right.
or a standalone entity, hence a venture, right? That particular venture is normally one where the corporate is saying it's a capability that they want to understand better or learn. A good example of that would be one of our work in Malaysia with a large telco, which is said, we're a telco, but we have interest in supporting the Malaysian and beyond that digital education. So we're going to create a venture that is outside of our core to actually explore what would education through mobile and things like that would look like. So that's an example of a venture.
Okay, so let me hook into that, because I'm doing a transformation for about a year together with telecoms. I'm helping them as a coach, as an executive coach, to implement a digital unit, or to make their digital unit more agile. And in Telkom Indonesia, they have multiple initiatives for the last 3 or 4 years to stimulate entrepreneurship or to create innovation. So they have the Amoeba program, in which I think the idea is they build with their internal people, they build ventures. People are allowed to come up with ideas, and they get money and time to work on those ideas together with a team, and they have certain metrics that they have to achieve. Then they have the digital division, which is where I'm doing my work right now. So it's the traditional digital division organized in an agile way. And they have the Indigo program, which is to make Telkom collaborate with external startups. So those are all internally driven things, except for Indigo, because Indigo basically says, okay, we have a co-working space and we have support mechanisms from Telkom to collaborate with Telkom to bring your startup innovation to market. How is the model that you are bringing different?
Okay. I think you've mentioned one word there, which was quite interesting, which is internal, right? I mean, and leveraging internal resources and whatnot. If you look at the whole idea of what driven a lot of the topic around innovation is actually what we call startups or ventures in the wild, right? Which are ventures that are started by two people in their garage, like
Why
the
in the
mythology
wild?
said. Oh, in the wild, because they're not being helped by anybody else, right?
Okay.
You know, so basically, you know, the mythology of two people in their garage coming up with
hero,
something,
right.
exactly, right? And I think that is a bit of the idea. Now, within Wright Partners, we actually don't subscribe to the mythology of, like, you know, the founder being this magician that, you know, makes things happen from nothing. But we do subscribe to some of the mentality that suggests that the idea that there is equity, the idea that the founder, or, you know, is actually running a bit of his own show, makes him much more motivated than an employee, say, getting a little bit of money, a little bit of time, and knowing that the upside pretty much doesn't accrue to him.
Yeah.
Right. So there has to be some risk reward mechanism
Yeah.
to support venture. That is awfully difficult at times to do within a regular corporate structure. That's where we come in.
Why is that difficult to do?
Because the mindset of changing someone that was an employee until today and basically saying you're not an employee anymore. So your current management structure no longer applies because now you are an entrepreneur. So you have a lot more decision factor.
Yeah.
You get a lot more upside. You suddenly get equity instead of getting just salary and whatever it is. That's a switch that is difficult to happen within an organization.
Yeah.
And even identifying that person, you know, we do find that there's people that are inherently more interested in tolerating some sort of risk with the reward, and some people that are saying, I'm actually less interested in risk and whatnot. And that makes it within a corporate structure, you know, that identifying who's who is often not so easy. Taking them out from the day-to-day business to start working on a venture you were asking earlier, also means risk, right? So the idea that I'm now taking a semi-senior manager who has a P&L or something like that and asking them to work on something new is also complicated for most businesses.
Yeah. So one thing that triggers me now is that I'm an entrepreneur, right? I started a couple of companies out of nothing. So I kind of buy into that myth that you just described because I do it myself. But I also see why it is limiting in a certain extent, especially if you do it alone, like me. But what I find challenging sometimes when I help my clients, because I'm trying to bring entrepreneurship there, right? So, but what I see is people are sometimes, it's not only about the risk, it's also about being able to see that something vague, something far out, like I'm trying to create something into the future, and I have a notion of what that could look like, and then translating that to actions today, or maybe the next month or the next quarter to get there. I think that ability lacks very often in traditional, let's say traditional people working in a company. How do you see that?
I think the nature of corporates versus the nature of startups in the wild, as we discussed, is a bit different. A corporate normally has its next quarter's goals or 2 quarters goals,
right,
and it has to make money and it has to be profitable. Ventures, as we see now, and one of the reasons why we are challenging a bit, and the idea of the normal venture in the wild is because we do think it's went the complete other way, where many ventures are not ever expected to make a profit. I mean, if you look, at some, which doesn't actually make sense. But there's somewhere in the middle that says, can I create a business plan or a vision that goes a bit beyond the next quarter, beyond the next 2 quarters? And that's what we are trying to create, right? Now, the way to merge those two together, and is what we started doing, is to actually bridge that next quarter, next half view of the corporate with the slightly longer view of the venture. And the way we do that is by mixing a bit between the corporate assets, bringing the entrepreneurs from outside, giving the optionality to the corporates to allow them to actually understand and make the right decision along the path of building the venture. But exactly, it addresses the gap between I'm an entrepreneur, hopefully something will work out someday, right? Because I'm willing to take so much risk, versus I'm a corporate. I want to innovate, but I also have to focus on the short term.
Yeah. Okay, so I think what I take from this is the challenge of getting the right people in, right? Because in that venture, what makes the difference is the guys that you get in. Because if you have only the people who are used to this traditional notion of making KPIs or making the quarterly objectives or financial results, if you bring those into the venture, it's going to be challenging. So how do you, as Wright, get people in there? What's the structure? Like, how do you get the right people in and surrounding that venture to make it work, to bring that in?
So normally we actually suggest to the corporates to start building the venture outside of their core processes.
Yeah.
So we often do not bring in people from the corporate as well to be the co-founders or whatnot.
None.
We often do not, right? Are there special cases where some people will say, no, I really want to move? Yes.
Okay.
But again, the complexity of moving someone from a daily job and whatnot to something that is not, and the whole structure changes, is not trivial, right? As such. What we do is we involve the corporate side in the co-creation process.
Right.
So they do get to learn how we do innovation, what is important, and all of these things through the process. But we normally bring the venture founders and the team from outside.
Okay, so that also means by bringing people from inside to the program, they'll learn how to do innovation. So it's also a good school for other people to do it internally later on.
For sure, right? I mean, because there's lesson. So now we're talking very, very tactically, right? So let's talk about how we run a venture. So we run a venture normally with a daily stand-up in Trello and all of these things, right? That you will be very, very familiar with. That's very similar to your agile, because that's normally very, very exactly, and it's very dissimilar normally from how corporates operate, which is why you also do your kind of business. What they get to see as part of the venture building process is not necessarily how they transform their day-to-day operation, but how this approach leads to a brand new venture that goes.
Okay. But how do you attract a pool of people like that to help you? Because that's not easy.
No, that's not easy. I mean, if we reflect on our business model for the last 6 months, there's 3 main difficulties, and you've just identified one, right? The 3 difficulties are, just to list them and then going to your question, is one would be exactly identifying the right talent, right? And I'll get to that in a second. The second one is educating the corporates,
right? Because
it is a new thing for them, and we'll probably touch that a bit later. And then the third one is getting the investment from outside, because VCs are not necessarily used to venture build model as such, right? Yeah. So these are actually the 3 challenges that as a startup ourselves we're trying to solve. How do we get the right person? And I think that is actually the crux of the thing. What we've learned so far is that it's hard.
Yeah.
right? So and I wouldn't tell you today that we've figured this out 100%. But the ways that we do it is that we actually say that within our first 4 months when we design the venture, we can bring in a venture lead. We actually don't call them venture founder yet, and we test them.
Right.
And within the first 4 months, the outcome of that is that they have essentially a 4 months worth of interview process, and we actually assess if they're the right fit to be the venture founder or not. Fortunately or not, I've had to change venture leads midway. Right now,
Right.
Who are the right people? The right people are people that, in our case, that are not the mythological founder. Not because those people are bad, because those are the people that will say, no, because those people are the ones that will say, why do I need help? I'd rather go ahead by myself, right? Yeah. Exactly. And some of the best companies were created this way, right?
Yeah.
But the idea of building a venture with a corporate and having ties to the corporate does mean that you need to be a bit more humble. Yeah. And a bit more willing to work together with others, right? So I think that is a key element. We call that coachability. The second thing is you still need the founder mentality, right? And so the way that you balance it is that the risk-reward profile of this mythological founder and the risk-reward profile of the people that work with us is slightly different.
Yeah.
Normally we get people that are a bit older, have families, or people that are a bit younger and are saying, I'm not necessarily that ready yet, but I need a little bit of help.
Yeah.
What we focus on more is actually building them over the 12 to 16 months that we work together with the venture.
Yeah.
And the reason why that's important is because we believe that first 16 months to get to that initial stage gate of investment is super important. And so we focus on getting the right kind of mindset and skills and whatnot. And then within our program, we build them over 12 to 16 months. By the way, this is one of the differences between us and an accelerator, as you mentioned earlier. Because accelerator focus on a 3 months process, giving some classes, doing a few introductions, building a prototype on the side, and hopefully everything works out.
Mostly that doesn't go anywhere.
Well, I wouldn't.
If you look at the statistics, I would have said that.
I wouldn't disagree with you, but I also don't want to diss my competitors and such. But I think more importantly for us is to say, actually, venture building is a long process.
Yeah.
We do get into how do you develop the SOPs, how do you actually achieve sales. How do you actually do all of these things within the 16 months? We act effectively as co-founders for the first 4, and then as many co-founders for the next 12.
Yeah.
Right.
Yeah.
And so that is the way that we solve it.
Okay, let's zoom into that because I think that's also important, and it relates to your second point that you just mentioned. How do you get started with this, right? So the traditional idea is I hire a consultant, right? And then it's one of the big 5 usually because they also do some venture building. So I was triggered by a video I saw from Steve Jobs in which it's an old one, I think 20 years ago. And then he said something about consultancy. So he asked the room, is there anybody who's a consultant and started bashing them a little bit. But what I liked about the thing that he said, because I actually don't like to be a consultant myself. I kind of hate it because I want to
You're
get
an
stuff
entrepreneur,
done.
right? So
turn consultant to help them, but then you still consider it as a consultant, right? But eventually you want to get stuff done. That's what gets me out of bed. I want to change things and innovate. But what he said is the most important thing or the most important issue with consultancy models is they have no skin in the game. And I'm thinking that you may have found a solution to that or a formula that can actually work. So how do you bring your own skin into the game?
Okay, so we actually don't start with that as a thought process. We start first with what is a venture in the wild.
Okay.
And that's important. So if you look at statistics and PitchBook, you will see that it costs about 1.6 to 1.8. It goes up a little bit of a year due to inflation and whatnot to bring a venture over 16 to 18 months to a Series A. Right. And that is the benchmark. Now, if we take away skin in the game for a second, if you look at most of the consultancies, if you're talking about $1.6 million for 16 months, you would hire a consultancy, and most corporates, we know this, from anywhere, for that amount of money, you anywhere get from 3 to 6 months of consultancy, right? You haven't yet paid for the tech, you haven't yet paid for customer acquisition costs or anything else. That's just the fees.
Yeah.
So when you look at that, it's very, very difficult to say then, how do you relate building a venture versus a consultancy in terms of that? So what we do instead is we actually peg our fees, as you will, for the first phase, for the design phase, as actually a pre-seed investment.
Yeah.
And that pays. And in fact, just yesterday we did an accounting review of kind of what that would mean. That basically pays for 4 months of delivering the venture to the investment committee at the level we want, right? Zero margin, absolutely zero margin. And in fact, what we learned is, and this is an interesting element about corporates, that even after the investment decision is made, it still takes probably a month or two until you actually get the company incorporated and whatnot.
Yeah, sure.
So the implication of that, we still need to carry that risk because we don't want to lose the venture founder in the middle or whatnot, right? So what you see is you move from a model that you pay 4, 5, 6 people, $1.5 million for 3 to 6 months, depending on which consultancy you hire, to having that budget have to go away, to go all the way to 1.8 million. To 16 months. And that's a big change. And that is an element of the skin of the game. So what normally we say is very clearly is that for the first 4 months, there is zero margin, and therefore we allotted a bit of equity. Our upside, our margin is actually converted into equity. When you think about it, it actually means that our cash compensation is worth less because now we're trading it into equity, right? And equity, obviously, the dollar today is definitely always worth more than a dollar tomorrow. So we take the risk already, right, as such. For the next 12 months, the amount of money that we ask to actually support the day-to-day is negligible compared, right? If you put it in the tunes of even some of the cheaper consultancies, probably 1/10 of what they ask for, right? For that. And we take on then the responsibility of making sure that the venture arrives to a Series A, to an investable status. And so the risk is on us because if the venture actually doesn't achieve the investable status at the end of the 16 months, we lost. Right? We actually, we barely paid for our bills or whatever it is and stuff.
Yeah.
So that is the way that we treat it.
Okay.
The funny thing about that approach and getting into the education of corporates, in most of our discussions, we find that it's much easier for corporates to pay $1.5 million for a consultancy for 3 or 4 months than to say, oh, I'm going to pay 1.8 and I'm going to consider it as an investment.
Yeah.
That is where I think the interesting gap in the model is, and where I think our opportunity is, to be perfectly honest, right? Because if you look at it from the other side, if we turn it upside down, you either pay 1.5 million for 3 to 4 to 5 months of a consultancy and you get a beautiful report, or and then you're done learning, because at the end of the day, at the end of the 3 or 4 months, you're done learning about whether, if you're a telco wanting to learn about fintech, you hire a consultancy for 3 or 4 months, you get a once report. But if as fintech keeps moving on for the next year, you're done because you don't want to pay again, right? Or you pay the exact same amount and you get a 1.5 years, almost 1.5 years worth of learning, plus a company at the end, if it makes sense, right? So actually the trade-off is pretty clear, but the education, going back to your point about this is the second problem we're trying to solve, the education of these corporates becomes super interesting. And what does it mean?
So how to do this, because the corporate structure is not that easy to just boom, start a new venture somewhere outside.
Right. And I think that's exactly the right question, right? So we're exploring different models, right? I think the ones that already have a CVC or whatnot, it becomes a little bit easier. I think others,
CVC means?
Corporate venture capital. Please, sorry. One of our corporate partners, which is a bank, has a CVC, so it's easier for them to actually make an actual investment. And another one, we're exploring a model by which they buy a consultancy service, but for that much cheaper. And then at the end of the consultancy service, they get a $1 warrant to buy X% of the company. Right. And so what we believe will happen then is that, and we would form the company in between and whatnot. So everything will be done. And then at the end of the consultancy project, they can, whoever the corporate governance is, they go back to the board and say, hey, by the way, here's a beautiful report. We've now learned about this industry for 1.5 years. And by the way, we now can own for $1 X% of this company. And that means we already have a return on investment because this investor wants to come in, right? So that is what we're now trying to construct.
Okay. I think it sounds super interesting. I want to zoom in again about on the skin in the game of the founder, because yesterday our mutual friend, I had a coffee with Petian for 2 hours, who started Genius and BTPN and now started Jago. And what I found, what triggered me is he's a CEO, right? He wears a suit and he's I would say he's a senior guy. But in that conversation, it was only 45 minutes having a chit chat. He takes his phone and then he became so passionate about showing the app, showing all the details. They have made some interesting features like sharing certain pockets of money with your wife or your driver. And when I see that passion, it really opened my eyes. So I was thinking, how do you make sure that if a founder comes into this venture and works for this big corporate, and also for you, how do you get that passion and energy of the founder into it? He also needs to have some skin in the game, right? So tell me how this works.
So I think so. First of all, what we try to focus on, other than I think consultancies and whatnot, is what we call investable corporate ventures. Investable corporate ventures means that at the end of the 16 months, they would be open to a Series A. That brings us to the third point of educating the VCs, right? The one thing that VCs all traditionally talk about is that they invest in the founder. So the founder is actually the most important. Ideas, execution, all these things, right? And so when they meet an investable venture, their first question is to say, okay, how much equities does the founder have? Right. Because I want to know that he will stay here for the next 3 to 4 or 5 years and is incentivized. Exactly. Right. So we actually solve that in a couple of ways. One, we do have a suggested corporate structure for these ventures, and we actually are able to work it back into numbers and show that it's still a good investment for the corporate structure. The second thing is what we've learned, and we've seen this a couple of times, is that again, and this is the kind of the idiosyncrasies of a corporate, where the CFO needs to prove a return, right? And he needs to prove control. So when we first discuss about investable ventures, say, I want the control over everything. Okay, awesome, right? Not easy, awesome. Let's figure it out. But then when we get to the investable part, and we actually bring in a VC, they said, but now I get my return. And actually, the IRR on a Series A venture normally is actually much higher than the IRR on a later round.
Sure. Yeah.
And so you're coming back to the same your same CFO, and you say, okay, listen, you can get an investment now and you can book this return, but that means you also need to get diluted a bit more because we need to make sure that the founders and members, but you get your multiples, your 5x, 6x, whatever it is return, right? Depending on how well we can do this. So what all of that alludes to is that the founder one starts with an equity. So we bring in a person that does start with equity, right? And the equity needs to be substantial.
Yeah.
And more importantly, as we see again and again at Series A, there is more opening from the corporates to start saying, okay, you know what? I'm happy we got to this. I'm willing to dilute a bit more because I'm getting my return, as we discussed earlier. But now I'm allowing for the founder to really be secure in the way pushing it forward, right? But for the corporate, the way we do that, and this is where it's a little bit different, right? If a consultancy comes in and you've already spent $1.5 million on just the consultancy, the cap table and the amount of money invested is so far out of whack for any venture in the wild compared to any venture in the wild that it's very difficult to fix it then,
right?
Because the amount of money invested compared to the actual result, not so high, right? In our model, because we focus on investing a lot less money and focusing it on the actual venture, we do say to the corporate, hey, you get to invest and you get this much equity for this investment. That puts your valuation at X. I'm bringing in a founder and this is part of his equity, right? And by Series A, you will have your return. The founder will be much more comfortable, and that's the way going forward, right? The second element of it is us, right? Which is to say, we ourselves get as giddy as you were just describing, right? Where we do go to the field, we do spend a lot of time, whether it's looking at one of our ventures, looking at how chickens are slaughtered, and unfortunately,
that's an interesting one. Yeah.
And going to the field and speaking with farmers, right? So we also take this founding approach, and that is part of the passion we're trying to bring. Right. So what we do is, again, venture in the wild will always be like, I'm a diehard. Corporate will always be like, I'm an employee. We try to strike the middle by saying, how do we merge the best of both worlds, equity, passion, stability, and all these things.
I like that. Okay, so imagine that some of our listeners are triggered by what you've just shared, and I think, especially the corporates, it's far off from what they're used to, right? So, what are some things that they could contact you for? How do you get started with this?
Okay, I think there's a couple of ways to get started, right? The first is to have a discussion about what is the innovation/strategy of the corporate.
Right.
I think that's a discussion that's worth it. And does it even make sense to build an investable venture? I think that's the first question, right? And normally that question we've discussed, but my board might approve consulting and might not approve venture building or this and that, right? What is the right venture that we should be building? If it's a digital bank for a bank, that might not be an investable venture because it's too close to core, right? But if it's agricultural play for a protein player, that might make more sense, right? Which is an example of one of the things that we've done, right? And so starting to map what is core, what is really worth learning, and again, as reflecting on our discussions with some of our corporate partners lately and the consulting approach, it could also start as, hey, what industry would you like to learn about in a very fundamental way? And would learning about it through a venture versus hiring a bunch of consultants, would that make more sense, right?
Yeah.
But I think the sweet spot would be, market is being very volatile. There's areas in the non-core that could become core in the future that we need to protect ourselves about, but we're not willing to make such strong bets on them yet. Or we're trying to slowly move our business away from being a dumb pipe. We're trying to slowly move our business away or towards our customers or whatever it is. And we don't know yet what the future will hold. And therefore, we should explore a venture-built opportunity. Right? That is the approach for the corporate. If a corporate already has a corporate venture capital, or if they tried accelerators before, what they will find is normally two things. One is that often the price that they can get into a venture is a bit too expensive, because the corporates will always get a premium because, oh, you're a corporate, I already have this VC and whatever it is, and they'll end up paying a bit more. And the idea there is, if that corporate can find a venture that is more interesting to it, it can actually build it at much lower cost and get much higher equity, right? And that's the story for corporate venture capital. If you've tried an accelerator, one, you will find out similar things, that you give a lot of money at the end of an accelerator, but you actually only have a very minuscule part of the venture, because that's how accelerators are structured. So the ability then to get strategic alignment between the venture and the corporate is quite limited. And so again, you will want to pinpoint a couple of places where you might not even invest much more money than you would in the accelerator, but you actually get a much better alignment of commercial. So I think these three are probably three ways to come in, but it all starts with, what is your strategy around innovation? What are the potentially non-core elements that would be interesting for you as learning opportunities? And how would you engage with those as a way to start driving them up?
Right. Okay. So I think this is a beautiful closing of our discussion. It gave some ideas on how companies could actually start thinking about in this way of innovating, how they could start identifying opportunities for building corporate ventures, and how to reach out to you. So where can people find out more about you?
Wright Partners is one.
I like that URL, by the way.
Thank you. Yeah. Right. So Wright Partners.
And Wright, by the way, is with W and then Wright.
Yes. So like Wright brothers. I mean, the reason why we've taken that is because, inspiration from how. So if you actually learn about the Wright brothers, they were not the smartest kind of people in the room, and their backgrounds was not aeronautics at all. It was bicycle building. Right. So there's a whole lot of interesting stories of how they were coming, about and what they're doing. We thought that their philosophy for innovation was actually an interesting one. So yes. So Wright Partners is one. Partnering with Equipa, right? With your company is another one.
So you could also contact me or one of my colleagues to have the discussion.
So I think and that would be a good way to start.
Okay. So Ziv, thanks for having this conversation, and I'm sure we'll have many more conversations like this. So thanks for listening, and if there's any questions or discussions you would like to follow up on, please reach out, and then we can have a conversation one-to-one or with a group of your team. Okay, thanks.